Hello everyone, my name is John Drennen. I'm the sales manager at Fairway Independent Mortgage Corporation here in Las Vegas. I am here to tell you what you need to know because other lenders are not. There was a mix of tricks and treats among last week's labor sector, home price, and Fed rate headlines. Here are the highlights. Lower job numbers, closer to real picture. Private payrolls below expectations. Jolt, higher for job openings. Continuing jobless claims reach a 6-month high. Is the Fed done with rate hikes? Home prices hitting highs. Lower job numbers, closer to the real picture. The Bureau of Labor Statistics reported that there were 150,000 jobs created in October versus the 180,000 forecasted, which is the lowest amount since June. Revisions to August and September also shaved 101,000 jobs in the months combined. The unemployment rate rose from 3.8 to 3.9%. So what is the bottom line? There are two reports within the jobs report, and there's a fundamental difference between them. The business survey is where the headline job number comes from and is based predominantly on modeling and expectations. In fact, one of the biggest reasons we saw job gains last month was the birth-death model, where the BLS estimates new business creations relative to closed businesses and how many jobs it created. In October, this modeling added 412,000 jobs, but it's hard to believe that many businesses were able to start last month in the current economic climate, especially with the cost of capital. The household survey, where the unemployment rate comes from, is considered more real-time because it is derived by calling households to see if they are employed or unemployed. This survey has its own job creation component, and it is a completely different story, showing 340,000 job losses. Average weekly hours were also cut, which is important because one of the ways businesses cuts costs is to cut the number of hours. In fact, workers have lost about a half an hour on average since the beginning of the year. While this doesn't seem like a lot, across 168 million people in the labor force, it equates to 2 million job losses. Private payrolls below expectations. ADP's employment report showed that private payrolls were weaker than forecasted in October, with just 113,000 jobs created, while growth reached the slowest pace in 2 years. Also, all the job growth came in service providing industries, with good producing companies only adding 6,000 jobs. Neela Richardson, chief economist for ADP, noted that while the labor market has slowed, it's still enough to support the strong consumer spending. She also explained that big post-pandemic pay increases seem to be behind us. On that note, annual pay for job stayers increased 5.7%, and job changers saw an average increase of 8.4%. These figures have cooled considerably from last year's high of 8% for job stayers and 16% for job changers, which is significant because it suggests lower wage-pressured inflation. Jolt, higher for job openings. The latest job openings and labor turnover survey, JOLTS, showed that job openings rose from 9.5 million in August to 9.55 million in September, beating expectations. However, the hiring rate stayed the same at 3.7%, which is the slowest since the shutdown during the pandemic. The quit rate at 2.3% was also unchanged, and this low rate suggests that there's a lack of employers trying to entice workers with other offers. So what does this mean? Despite the monthly increase, job openings are down 1.3 million when compared to the same time last year. Plus, the report total for this September is likely overstated. The increase in working from home means job listings are being posted in multiple states and more frequently. As a result, they're being overcounted in the JOLTS total, meaning that the report may not be as strong as the headline suggests. Continuing jobless claim rose to a 6-month high. Initial jobless claims rose by 5,000 in the latest week, with 217,000 people filing for unemployment for the first time. The real story is continuing claims, which increased by 35,000, showing that 1.82 million people are still receiving benefits after their initial claim. The last time continuing claims was this high was back in April. So what's the bottom line? While initial jobless claims remain relatively low, they have increased over the last 2 weeks, with the latest data reaching highs not seen since early September. Continuing claims have also risen for 7 straight weeks. Overall, the data shows that employers are trying to hold on to their workers, but it's becoming harder to find people once they're let go. Is the Fed done hiking rates? After 11 rate hikes since March of last year, The Fed left their benchmark federal funds rate unchanged at a range of 5.25 to 5.5 at the annual meeting last Wednesday, just like they did in September. The Fed funds rate is the interest rate for overnight borrowing for banks and is not the same as mortgage rates. When the Fed hikes the Fed funds rate, they're trying to slow the economy and curb inflation. So what does this all mean? The Fed's decision to pause rate hikes for the second straight meeting was unanimous. However, Federal Chair Jerome Powell did leave the door open for another hike at the next meeting, December 13th. The strength of the labor sector remains a key factor in their decision, and with the Fed looking for clear signs that the labor market is softening, they could consider rate hikes. While the latest jobs reports from October were weaker than forecasted, it remains to be seen if it's enough for the Feds to pause additional hikes. The Feds will see November's jobs data from ADP and BLS releasing on December 6th and December 8th, respectively, along with upcoming inflation reports, which will certainly play a role in their decision. Home prices hitting highs. The Case-Shiller Home Price Index, which is considered the gold standard for appreciation, showed home prices nationwide rose 0.9% from July to August. After seasonal adjustments, this makes 7 consecutive months of growth. The Federal Housing Finance Agency's House Price Index also showed home prices rise 0.6% in August, with their index reporting gains every month this year. Note that the FHFA's report measures home prices appreciation on single families with conforming loan limits, which means they're most likely to represent lower priced homes. FHFA also does not include cash buyers or jumbo loans, and these factors account for the differences in the two reports. What's the bottom line? Home values have hit new all-time highs according to Case-Shiller, FHFA, CoreLogic, Black Knight, and Zillow, more than recovering from the downturn we saw in the second half of 2022. This year, prices were on pace to appreciate more than 6 to 8%, depending on the index, based upon the reported pace of appreciation through August. These indexes show that now remains a great opportunity in building wealth through home ownership and appreciation gains. Now you're in the know. Okay, that's a lot of information I just gave you, but let's kind of wrap it up very simply. So what do we know? Houses are appreciating. Unemployment is actually rising, so that means less people have jobs. The Feds have paused the rate hikes currently. Maybe they change their mind in December. We don't know what's going to happen. Every day is fluid in the mortgage world, but now you're in the know. See me next week.